Hello, everybody. Elijah here. Just wanted to touch base with everybody. I posted something on Facebook yesterday, and it was saying that we're drowning in information but starving for wisdom. And somebody commented on that, and it really got me thinking. He said that, what is wisdom? And I guess it sounded good. It sounded great, and I just decided to post it. But when he asked that, it really made me think, what is wisdom? So my definition of wisdom is the output of the results that you're taking. Okay. What is it that you're doing every single day, and how are you learning from that? Now, that could be a success. That could be even a failure. You acting, learning from it, and moving forward, I think is wisdom. I think it is sort of results based. Information is something that you know, but you've never acted on. So my point of that whole thing is, why would we listen to certain people who have information but never acted on anything themselves? Which got me to thinking even more so. I've been doing everybody who follows me a disservice. I've been in the mortgage industry for about 5 years. I've been in this financial industry for even longer, 8+ years now. And I've never really spoken to the homeowner specifically on my timeline. Now, for everybody who has a house, I want you guys to go ahead, grab a sheet of paper, grab a pen, and grab your mortgage statement. All right. This is going to be a very interesting exercise. So take the mortgage payment that you have and multiply that by the term. So your monthly bill, whatever that is, okay, even if you just do principal and interest, and you multiply that, if you have 30 years, if you did a 30-year loan, you multiply that by 360 because you have 360 payments. If you have a 15-year loan, that's a little bit better. You pay less in interest, but still, go ahead and do that. Multiply 180 times your mortgage payment. All right, once you get that done, circle it. Okay? I want you to remember, how much did you purchase the property for? Look it up. Even though most of you are probably going to remember that, because that is legitimately the number one expense most of us make, purchasing a house, right? Look at the difference. Look at the difference between what you purchased the property for and then what you're going to pay to own the home. Subtract the difference. For most of you, 30 years, you're going to be paying at least 2 to 3 times what the house was actually worth. Now, if you think this is unfair, it's even crazier to think within the first 7 to 10 years, you don't even make a huge dent into the principal. The principal is the actual amount that you owe on the property. The interest is the profit that's gained from the lender. So there's a thing called amortization, all right? Amortization. That's basically how your money gets split. So say your mortgage payment is $2,000. They split it up. In the very beginning, more of your $2,000 will go towards your interest as opposed to your principal. Now, this isn't exact numbers. I didn't run anything specifically, but I just want you guys to understand the concept. So let's say month 1, what's going to happen with a mortgage company or a bank, whoever you use, let's just say $1,850. $1,850 is going to go towards straight interest. Only $150 goes towards your principal payment. So you only knock down $150 of what you owe, even though you just gave them $2,000. What amortization does is each month that you make a payment, it's a scale. So it slightly changes in the favor of principal. So instead of, next month, $1,850, maybe you put $1,800 towards your interest payment. But now you have a whole magical $200 going towards the principal. So this is why in the very beginning, you see that not much progress is being made towards your monthly payments or towards your payoff balance. Of course, the longer that you stay in that loan, the more principal you're going to be knocking out. Now, the sad part about this is once I did some research, like I said, I was in the industry for a very long time. I used to tell every single body, go ahead, take your monthly payment, multiply it by your term, and just look at how much you're paying that company. That you have bought the house 2 to 3 times over. So I want you guys to just start to visualize and see what this could do for you. I've talked about mortgage-free life for a little bit. People understand a concept of, hey, I have no mortgage. That's amazing. But I never really made a video to explain and break it down. And I'm probably going to do this in a series. The first one that I'm doing today is just going to break down how it works. And then I'll go ahead and put some visuals in to help you out. So there is a product out here that can help you pay off of your mortgage balance and on average 7 to 10 years. I actually just helped somebody with this a few months ago. He's 33 years old. He lives in South Carolina. He had 26 years left on his mortgage, and we were able, with this same strategy I'm about to disclose with you guys, in 9 years. That's a huge difference. That's a huge difference, especially considering the fact you'll get calls from mortgage loan officers to refinance. Whenever you refinance your loan, you start that process over, that amortization process. So the mortgage company, not only are they going to charge you fees that adds to your principal, and then they're going to go ahead and start that process over so they get most of your monthly payments in the beginning. So with this strategy that we offer is called Mortgage-Free Life. Mortgage-Free Life is basically where you get 2 products put together, and the sum of the products is way more than the individual parts. So what do I mean by that? So there's a HELOC involved, which is strong in its own right, and then there's also a IUL involved, which is strong in its own right. But when you put them together for the single purpose of paying off your home quickly, it is much more powerful than just having them individually. A great example is the Belgian horse. One Belgian horse can pull, I think it's 3,000 pounds by itself. 2 Belgian horses can pull 18,000 pounds together. So that's exactly what the HELOC and the IUL and this mortgage-free life does. IUL is strong, HELOC is strong, but together they're way stronger. It just doesn't, it's hard to comprehend. But so what will happen? Okay, so how does it work? How does mortgage-free life actually work? So mortgage-free life is where you get a HELOC on your property. So for those who don't know what HELOC is, it's a home equity line of credit. It's basically almost like a credit card that you have for your house. So it's open-ended. You can use it over and over. And it's based off of how much equity you have in the house. If you don't know what equity is how much value you actually possess. Okay, so your house is worth $200,000 and you owe $150,000. You have $50,000 of equity. All right, so you can typically get a HELOC for that $50,000 or a little bit less. They usually don't give you 100%. So just to understand the concept, an IUL is actually a life insurance policy where you can put money in. You can also withdraw that money pretty much at any point in time. It also grows, okay? Your cash value grows and it's tied to the stock market. But the beautiful thing about an IUL is you don't have to worry about the downside. So you have protections put in place just with having this policy. So if the market goes down for a year, your account won't go down because the protection in place with the IUL. It'll stay at the same balance, all right? So you put these 2 things together. Now, there's a couple of factors that play. You need to have a positive cash flowing lifestyle. So say you bring in $10,000. We're going to try to keep this simple. You bring in $10,000 a month into your home. Your expenses are only $5,000. All right. Hopefully you guys are following me. You bring in $10,000, you owe $5,000. You pay the 5 out. You have $5,000 positive cash flow. So what'll happen is with this HELOC, you can actually access up to 90% in this HELOC of your value of the house. All right. So if you have a $200,000 house value and you owe less than 180, this is going to work for you because you can take a HELOC out for 180. You pay off the mortgage completely. Boom. Don't have to worry about that anymore. But now you have this $180,000 HELOC that you still have to pay off. All right. So we substituted the mortgage for the HELOC. All right. That's step one. Substitute the mortgage for the HELOC. Now, what'll happen is, again, you have to have a positive cash flow month to month. So if you go ahead and have that example that we mentioned, the $10,000 coming in income and only $5,000 having to go out, you can set it up in a certain way where all of your expenses are going into, all of your income is going into this one vehicle. Boom. It goes into the one bank, $5,000 goes out to your expenses, and then you automatically put the $5,000 towards the HELOC. So now your HELOC goes from 180,000, boom, month one, 170 because the income comes in, boom, you pay your expenses of 5,000, boom, goes up to 175. So month one, you pay $5,000 in principal down, and then you recycle it. Boom, month two, it goes from 175 to 165 because of your income, goes back up to 170. So within 2 months, you pay $10,000 off of your principal. So you continue that cycle, right? And then you also build an IUL in here. So like I said, the IUL is going to gain cash value over time. And each and every year, what you'll do is take a loan out from your IUL, your insurance policy, to go ahead and pay off the principal balance of the HELOC. Again, all of this is factored into you. You can actually make this automated, all right? By going through this mortgage-free life process that we have, you don't have to worry about a thing. You basically sign the paperwork, you get everything set up in the beginning, and then it's automated. And now you're thinking, well, if all the money's going into this, like, what can I do? What if I want to go on a trip? Well, like I said, it's a credit card. So say, 1 month, God forbid, tires go out, your water heater goes out, and you need to go ahead and purchase that, then boom, you swipe the credit card. You use your HELOC for that. Now, mind you, this is only for people who are disciplined, because some people see the lifestyle that they have. They're like, oh, let's go buy the boat that we wanted. Let's go to Disney. It can be dangerous if you're not disciplined, which is why I don't talk about it often. But it's a phenomenal tool if you are disciplined, because you see, using this strategy of literally paying off, in this example, $5,000 every single month. I mean, within 60 months, and just this example, just within 12 months, $5,000 times 12 is $60,000 you knock out just by your income alone. Not including how much your IUL policy has and cash value available that you could also circle into this. So in this example, it should only take 3 years to pay off your mortgage. The HELOC is paid off. You have an IUL that's growing cash value. You have your mortgage that you own. Do you not see how powerful that is? The difference with this is it's 100% going towards the principal. It's knocking down that balance immediately. It's not your payment of the $10,000 or the $5,000 that you have left over to go to the HELOC. It's not getting split up to interest first. It's knocking the principal down. So I just wanted to talk to you all about this, because for all of the homeowners out there, it's rigged. Go back to the exercise that I had you guys do in the beginning. Look at how much you actually spend versus how much you purchase the property for. Now, of course, there is interest. There's interest involved in this. But would you rather have this interest that you have to pay for 30 years, 15 years, 10 years, even if you got a 10-year mortgage? Or would you rather this vehicle where you're building multiple assets at one time? An IUL, mortgage-free life, now you have equity that's just growing. And then once it's paid off, you can rinse and recycle, rinse and repeat. You can continue doing this. So I just wanted everybody to hopefully grasp the concept of what mortgage-free life does. You're building a retirement income with an IUL that can only grow and never decrease. You'll pay off your mortgage on average. We're doing 7 to 10 years. I've had, well, not me personally, but I haven't had people on my team who've had people pay off their mortgage in 3 to 4 years. 3 to 4 years. Can you guys even imagine just thinking about this house where I'm sitting in right now will be paid off in 3 to 4 years? So it's a phenomenal product. If you guys have any other questions, please reach out to me. I can explain it in a different format. Like I said, I'm actually going to give you guys some numbers pretty soon and just start showing the flow of money, because that's all this is. You guys have the income right now to go ahead and pay this off sooner. It's just the structure and the flow of money and where you're putting it that is the damage. That's the damage being done, where you're putting your money. If you can just alter that, use different products, and be knowledgeable on what's available, you can change your life very, very quickly. So just wanted to go out and share that with you all. Like I said, this isn't the only thing that I'm going to talk about. And if anybody has any questions about their personal mortgage, because even if you think this is too much, you know, I've done a lot of different things with mortgages. I've gone from FHA, took people from FHA to conventional. It's phenomenal. You get rid of that mortgage insurance that literally, again, just goes straight to the insurance company. No insurance for you at all. I've done VA loans. I've done, those are primarily the three that I've done: VA, FHA, and conventional. I've done cash out refinances where people are taking their equity in their house, paying off some of these other high interest debts. And I've saved people up to $968 a month, which is over $11,000 a year that they're saving with the same income. Could you imagine an extra $11,000 freedom that you have? So like I said, there's a lot of different things that you can do with your mortgage, but I think this is by far the most powerful. Get rid of the mortgage, because the mortgage, it's not in your favor. It wasn't built for you. It's a cash cow for the banks, for the insurance. Go ahead, knock that out sooner, and imagine 20 plus years of no mortgage. What would that do for you and your family? How would that change your retirement planning? How would that change the quality of your life? So this was just the first one. Like I said, it all started from a random Facebook post that I put up yesterday. And I think that this could be very helpful to those who have taken their journey with home ownership. But I will advise you all, you know, don't be afraid of getting rid of your 2%, 3% interest rate, because what is that really doing for you? If you have to pay that for 30 years, 25 years, 20 years. Like I said, do the math yourself. You know, multiply, even with the 2% interest rate, multiply that monthly payment that you have over the amount of payments that you have left, or the term that you have, 360, 180, 120, whatever it is. You'll see that you're paying way more than what you purchased the house for. And if there was a way to condense that time, build 2 assets, and then improve your lifestyle, ask yourself, is it worth it? I'm not here to sell you anything. I'm just here to show you a different way. I'm just here to share my experiences with hundreds and thousands of people that I speak to. And I think that this could be something that's very helpful, not to everybody, because a lot of people in my age range, maybe 15% of them are homeowners. But if you think that this could be valuable for somebody who does have a home, share it with them. It's available. It's out there. And I think it's selfish not to share this. So I just wanted to apologize again for not sharing this information more vocally. And I hope that you guys found some value of this. Like I always say, let's grow together. And I'll definitely be doing a part 2 with some visuals. Take care.